domestic facing economies select global opportunities. Would that be the theme for the next 15, 18 months? You reckon?
Yes.
Give or take.
I'd still, our portfolio is still geared towards the towards the global economy actually reviving. Actually, if that revives, everything else is okay for the rest of the world also.
Yeah, but oh, sorry. So I'm misunderstanding. You're saying that despite that theory, you're still anchored towards the global economy and not necessarily inward facing.
Yes. I mean, you just have to find places where we are extremely competitive.
And which are?
Okay. Obviously, we're seeing the bottom of the pharma cycle that's taking place. Okay, chemicals and bits and pieces will continue to do extremely well because that's a permanent shift that is probably happening. Okay, some commodity facing businesses and a lot of soft commodities that will be there. Um, so those are the few places that we are there. On the domestic side, I think urban consumption will continue to hold up, especially places where wage inflation is higher than nominal GDP growth. Wage inflation in IT is still a problem. Okay, so I'd anchor myself into any of the consumer economies feeding into that cycle, which is essentially down South India. So those are the few places that we think will remain buoyant.
Okay. The last time that we've spoken about some of this export-oriented themes, a very interesting statistic that you told me was that you didn't remember back then. When was the last time that you saw completely deregulated balance sheets on the textile side? Now, how has that piece moved? Because I keep on hearing conflicting opinions about where is it that India is gaining versus where is it that India is not able to gain on the textile exports front. What's your sense on that overall piece? It's a small one, but I'm starting with that.
Yeah, it's fairly simple. You got the best balance sheets that they've ever had since I've known these companies. Now you just have to figure out. You have to find the right company in the right space, and you will be able to. I mean, you just have to wait for demand to recover for those guys.
Okay. What are conversations telling you, Kenneth? What's your sense of when you analyze the cycle? Will the demand recover in a hurry, or
this
is it
season is gone? This season is gone. So next season you will crawl back. So basically, you made a low in terms of the numbers from a euphoric high. You made a low, and next season you'll be back. Next season or the season after next. See, the thing with most of these industries and companies, and this includes the metal cycle that we're going through, is that all you need is a good or any manufacturing company or any business that is there, not just manufacturing. You need a great solid balance sheet, because when growth comes your way, you can financially leverage into the cycle. There's no point in having a debt equity of 100%. Then you get growth, and then you have to leverage your balance sheet higher to capture that growth. Right? Today you've got no debt on books. Right? If the financial cycle comes in, you can leverage your balance sheet or take debt, build up your market share, and then get your cash flow, then deliver again. And that's what the commodity cycle did to most of these companies.
Got it. Okay. Okay. And which prompts me to ask you one final question on this piece, which is that you are present or you are constructive on Indian metal companies as well.
Yes, we're there.
You are there.
There, the price to book multiples are at 1. So purely on a valuation framework, they work well. They're extremely competitive in terms of costs. Now we'll just have to wait till volumes actually show up. Not prices, volumes actually show up. And if volumes show up and you get elements of price stability, we are back.
Got it. You reckon that will happen in a few quarters down the line?
So I got the valuations right. I know these are the lowest cost per day. So you have to wait till it gets right.
Yeah, sorry. Companies which survive a down cycle, no matter how short it is, and you pick the winner. I remember your mantra. Yes. Okay. So thanks for that, Kenneth. Okay. Now, may I ask, actually, one final question, really, sorry, on this is what is your view on IT exports and because again, the management commentary thus far has not been shaky. We're waiting for the IT companies this earnings season to talk about the second half. But what's your sense?
So there are two ways to look at it. The global meltdown will push a lot of a lot will cut companies will cut a lot of IT budgets. You're seeing that happening with banks, and you will see that happening to a very small set of companies which are funded by external capital, which is private equity. So there you might have a cut in budgets that are coming through, but the rest of the development work that is there across governments and across companies, it shouldn't really get impacted. But yeah, everyone's got their focus on the bottom line, so they'll have to cut costs. Okay, and if they have to cut costs, I mean, outsourcing will be their best bet.
Hmm.
So I'm not too sure. I'm reasonably sure. Let me put it the other way around. I'm reasonably sure that volume impacts, if at all, won't be. Will probably be there for a year. It won't be longer than that. So if there's a volume impact on the downside, probably be there for a year. I'm not too sure. A lot of these companies are going to get pricing hikes. They will get
Agreed.
nominal pricing hikes, but they may not be able to pass on all the cost inflation that they see. So they're on a fairly good wicket. Actually, valuations are also they're not as I mean, a lot of the large ones are making 52-week lows. So they're not as expensive as they used to be. And you could get a company or two or a business or two out there that could do reasonably well. They're already trading at dividend yields. Some of the large companies are already trading at 5 and 6% dividend yields.
So is my question is that attractive enough, or do you reckon that because of this volume downtick, possible volume downtick, and possible margin squeeze because they may not be able to pass on the cost, you might get them at better valuations? Because since you play the valuation game, I'm trying to understand.
Yes. But I don't think it'll sink the boat. I mean, you're not going to get them at 15 times and 16 times valuation. I don't think that's possible. I mean, there's one company or two that's already trading there. There's
Right.
also a company trading at 10% dividend yield, and one of the large ones. But you're not going to get them as cheap as you want them to be.